Welcome. Today we'll be talking about a company called Stellantis. This is a automaker company, and we'll be looking at the company's financial reports and the current problems that the company might face, connected mainly to tariffs and how that might impact the earning power of this company and thus the stock price. So we'll talk about what cars are behind the Stellantis brand, about the stock price and broad market data, financial reports, tariffs, and at the end we'll compare it briefly to Volkswagen stock. So Stellantis is one big group that has many different brands underneath it. In here I have a picture with some of them, with Chrysler, Fiat, Peugeot, Lancia, Alfa Romeo, Ram, Opel, Jeep, Maserati. So there are a lot of different brands that are behind the Stellantis group, and they are very diversified, and also they sell them nearly all across the world. Although in regions like China, their business is not going very well, as the Chinese competitors, maybe they don't have such a strong brands that people don't look at the Chinese cars and say, oh wow, that person has a lot of money, etc. But the value for money from the Chinese manufacturers is very good. And this is a big problem, not only for Stellantis, but also for other car companies like Volkswagen, for instance. That companies like BYD, for instance, they are just amazing and they can produce great cars at lower prices. So this is a huge disadvantage for Stellantis, that the competition from China is very fierce and is gaining more and more of the US. Although with the tariffs, maybe not the US, but for sure the European market. If we look at the stock price of Stellantis, we can see that is very volatile. At the end of 2024, the price rose to 30, then dropped down to around 12.5. Currently, after tariffs impacting heavily the company's earnings in first quarter of 2025, the price dropped from that 12 to below $10. Currently, the price is at around 9.5, with the low around $8. And that price last time was seen during the 2020 COVID crash, when the price went even lower to around 6, and also in 2016 the price was at 5.5. So we are not at the lowest point compared to historical prices, but still it is very low, and we will look later at the P ratios. Sadly, they don't look as good as the chart. On the chart, we see a huge sale, but sadly, this is because the tariffs really impacted the company and the earnings went down. So the current drop from the high of 28.30 to a low of around 8 something is a drop of 70%. So this is a very significant change, and this just shows how inefficient the market is, that sometimes people get very optimistic and can drive price to 30, and then half a year later it's at 10. Compared to previous historical price movements, you can see that during the drop that started in 2018 and lasted till 2020, that also includes the COVID crash at the end, we had a minus 75% decrease in price. And in 2016, 2017, in 2015, 2016, the price also went lower, but in this case 50%. So this stock, it has a tendency to go up a lot, but also crash a lot. So it's volatile stock in competitive industry. So this is not a very safe bet, but as we will see with this one, compared to other auto manufacturers stocks, they are running on low debt. So this is one of the things that is different for this company than for any other automotive company. I think also Tesla has less debt than the industry, but car companies, they usually are massively in debt. So the price dropped 70%. We have the tariffs. The company Stellantis produces its cars in Mexico and Canada, and there were tariffs imposed on those countries. So when Stellantis wants to build a car there and then ship it to US to sell, it needs to pay that tariff. So it's like an additional tax of around 20-25%, I think. So it's a huge tax, and it was added recently, and now the company is facing a earnings drop. The CEO of the company says that the earnings might drop by around 75%, so that's a huge drop. But of course, maybe they will be able to avoid the tariffs by moving the shipments first to some other country, then to some other country. Maybe they can do it like this, or they can just close the factories in one place, maybe sell them, maybe reopen them elsewhere. But of course, all of that creates problems and disruptions and is not good for the company. But if we look at liquidity metrics that tell us what is the probability of the company going bankrupt, at least in the next year, the probability of that happening is quite low, as we can look at the current ratio. So those are the assets, short-term assets compared to short-term liabilities. So short-term assets are 109% of short-term liabilities. So the short-term asset number is bigger than the liabilities. The quick ratio works similarly, but I think it excludes inventories. So any cars that are laying around in the company not being sold, they are excluded from that. But if we look at days inventory, this is 57 days. So their inventory is also very liquid. So we can say that the current ratio is a good indicator of their liquidity, of their ability to sell, to create money in order to pay debt. So there are not there isn't a big problem, at least for now. The company is earning money and they have enough assets to cover the liabilities. And also very important, the cash ratio for this company is very significant. It's 0.5, around 0.5. So that means 50% of short-term liabilities can be covered by cash, or maybe it is even of all of the liabilities. I will check it. Let's go here and we can see the cash to debt. So currently, if we look at all of the debt the company has, it can be covered by cash completely. But this indicator we're looking at in here, this is the short-term liabilities to short-term assets. Sorry. Short-term. Everything in here is short-term, so 1 year. So 1 year of liabilities that are coming due, they need to be paid in the next year. 50% of that can be paid by cash. So that's a very good ratio, especially if the company is running into some problems. It's good to have some extra cash lying around. Another metric can look at cash to debt. That's the chart I showed you earlier, that the company has exactly the same amount of cash as debt. So there isn't a lot of debt used. If we look at equity to assets or debt to equity, we can see that those values are around 0.4, and that indicates that around 40% of the company's assets are financed by shareholders' equity. So we can say that around half of the company is financed by debt, half of it is just financed by equity, by some money that the company generated, etc. If we look at the margins, they are not looking amazing. The gross margin is 13, the net margin and operating margins are at around 3.5%, so that's quite low. Actually, the return on assets is at 2.6. So those things suggest that the company needs to employ a lot of capital, make a lot of investments in order to generate a very mediocre amount of profits. So if they invest $100 into their assets, they will earn around 2.6 every year from those assets. So compared to other companies like Google that has gross margin of around 60%, the 13%, maybe it's not the best investment you can do at the current time. But of course, this doesn't look at the price to earnings ratios, because for instance for Google the price to earnings ratios are at around 20, while for company like Stellantis or Volkswagen the price to earnings ratios can be like 3 or 4. So those ratios are much lower. So as we can see, the return on assets for Stellantis currently is around 2.5, but it was even lower in period prior to 2018, when the return on assets was around 1 or even close to 0. The gross margin of the company also dropped significantly from around 20 to right now it sits at 13. So we can see the tariffs really interrupted this company. And now we go to valuation metrics. So in here, we can compare the price of the company to the earnings. So currently, the price to earnings ratio is at 4.5, so it's quite low. The price to sales ratio is at 0.16. So that means if we buy Stellantis stock for, let's say, $100, then this $100 investment will bring revenues of around 500. So price to sales rating is very low. This company is generating a lot of sales, but because of the low margins, the low profitability metrics, we can see that not a lot of those sales are transferred then into profits, because this company generates a lot of costs, etc. Then sadly, just because we have such a great price to sales ratio doesn't mean that the company is super profitable. And the price to book value is currently at 0.3, and that is also because the return on assets is so small that the market prices the book value as not a great thing. They have some machinery, plants, equipment to build cars, but this is not very profitable. So the price to book value is at 0.3. So we can buy the entire company at 30% the book value. That also means that if some competitors, for instance, would like to buy some factories or plants or equipments from Stellantis, they will probably pay much more. So in reality, not on the stock market, but on the real business world, those plants, equipments, they are worth probably more. So sometimes when the company might be selling some of its buildings, etc., they might earn money on that. And currently, the PE ratio of Stellantis is quite high, and that is because of the drop in earnings in the recent quarter. So this is because of tariffs. The company is in real trouble because the price to earnings ratio went from around 3 all the way to 6. Then the price crashed, so the price to earnings ratio improved a little bit, and right now it's at 4.8. But it's still worse scenario than at the medium that is at around 3. So here we can see that, okay, maybe it's not a very expensive stock. Maybe the company doesn't have a serious probability of going bankrupt because they are still earning some money and they are still profitable and they don't have a lot of debt. But it's not as good as it used to be. The tariffs, this is a real issue for the company. In here we have a chart that shows the net income, and yeah, we can see the drop in last quarters, but also a significant increase in earnings that is correlated to increase in profitability during the years 2020 and 2023. But sadly right now that dropped. And as we can see here, the price compared to EPS, so the blue line is price and the green one is earnings per share. So the price declined similarly to the earnings. So you can see the market in this case is quite efficient in pricing the company, as there is a 65% correlation between price and earnings. And let's now look at the cash flows of the company. So we'll look at the cash flows from financing. So it doesn't look very great, because we can see that it is a positive number of 9 million here, but there is a lot of issuance of debt. So the company has positive cash flows from financing, but this is because they are taking on debt. So they are taking on debt, and that is showing a positive cash flow from financing, but it's not great. It's not great. It would be better if the cash flow from financing was, for instance, negative, but they were repurchasing their stock, for instance, which they are not doing right now, and they didn't do it in last years. They are also not paying a lot of dividend. They are just taking in debt. If we look at the investments, the number is much lower than the debt they are taking, but we can see that they're investing some purchase of plant property, so they're buying some machinery, maybe building more factories, etc. So this is okay, but it doesn't look amazing. And now let's look at the growth of the company. So we can see the revenue. It went from around 12 billion in 2013 to 2019. It was at around 12 billion. Then there was a COVID crash and the revenues dropped to 6 billion. And right now, during the 2020, we had a comeback to 18 billion. So a lot, 50% above the 12 billion. And in 2024, the peak was at around 21. And then we had a small crash to 17. So the revenues didn't drop a lot, but the earnings did. And here, let's look at what regions Stellantis works at. So the two biggest regions is the Europe with 67% and 40% of sales are in North America. So this is where the problems are coming from, because majority of the sales, around half of the company's sales, is coming from the region that has new tariffs imposed by Trump. And those tariffs are really hurting Stellantis brand, because all of that revenue, all of that cars sold in the North America, in US, well, now they need to be taxed extra 25%. So that's a huge price increase, and customers might not be so likely to buy those cars. And now let's look to Volkswagen. In here, the cash flow from financing looks very similar. This company also takes a lot of debt. They pay that debt, okay, but still 50 billion of issued debt, 40 billion of payment of debt. The cash flow from financing total is 11 billion, but just the net issuance of debt is 10 billion. So the cash flow from financing is really going towards issuance of debt, but we can see also 5 billion, around 6 billion for dividends, and that is a better reading than we had for Stellantis, because in recent years Stellantis is not paying any significant dividend. And when we look at the investing, in here we can also see purchase of plant property, etc., but also a lot of net intangible purchases, which might not be as great as the tangible purchases of properties, etc. Oh, sorry. And the next indicator is the comparison of price versus EPS of Volkswagen stock. And also, if we look at the chart, we can see that it is somehow correlated, but not so much. The price increased in 2021 to the middle of the 2021, and then the earnings per share stayed around the same level, while the price started dropping and right now sits very low. And here at the end, and in 2023, the earnings also dropped a little, but they dropped less than price. So maybe the Volkswagen is a little bit better, especially because he's not facing the problems that come from tariffs. So summing up, Stellantis is a good company that faces a lot of pressures that come from the newly imposed tariffs on Canada and Mexico. And as long as those tariffs are present, the company's earnings dropped significantly, but still, I think it doesn't pose a risk to the company's operations. The company can still function, although maybe it will create a need to move the production to different countries, which also puts a strain on the business, and those are just problems for the company. So it's not some anomaly. The price is dropping because there are problems. So the company is okay, but it's nothing crazy, I would say. It looks good. The price is quite cheap, but for me personally, it's very difficult to say anything about the tariffs. Are they going to continue? How will they impact the company in the long term? And when will they stop? Because Trump will be in charge for another few years, and if those tariffs remain, then this will impact the profitability of Stellantis. And maybe through some good business processes, they can move their production or do some tricks in order to avoid the tariffs legally. But for now, we can see that the earnings dropped and the P ratio is not as low as it used to be. Because the low P ratio meant that the company created a lot of money. It earned a lot of money, and as we can see, the price went from around 5 or 10 in 2015, 16, 17, all the way to 30 in 2024. And that is also because of the low PEs. The company just creates a lot of money. And of course, there are some problems with the Chinese, with the tariffs right now. But still, this investment doesn't look terrible. If you are looking into car companies, you want to buy some car company stock, and you are not scared about the tariffs, or maybe you believe that Stellantis can avoid the tariffs, or maybe that the tariffs will be lifted, then this can be a good company to jump into. And if you are holding this company, maybe you are scared about the company going bankrupt or having some issues, the company is financially healthy, stable, and doesn't have a lot of debt. So that is also quite nice. All right. Thank you. for your attention. I hope this video was entertaining and helped you understand the financial position of Stellantis better. Thank you for your time and have a great day.